Thank you for joining us. You're listening to the Beyond 50 radio program. I'm your host, Daniel Davis. Well, we're trying to figure out if we're ever going to get out of this economic mess that we seem to continually keep going downward into. And believe it or not, there are always answers to any kind of problem that is out there. The question is what kind of answers those are. Joining us here on the Beyond 50 radio program today is someone who has accurately forecasted by going back and reviewing our history and finding things such as common trends and cycles that are just common when it comes to economics that doesn't seem to be practiced or even spoken of quite regularly as we should be hearing in the news today. With us today on the program is Harry S. Dent, Jr., and he's here to talk with us about his new book, The Great Depression Ahead, How to Prosper in the Crash Following the Greatest Boom in History. And I'd like to welcome to our program Harry S. Dent, Jr., and thank you for joining us here on the Beyond 50 radio program today.
Well, nice to be here, Daniel.
You know, now this is interesting when I was reading in your book because you're talking about things that you're not commonly actually reading about or hearing about in the news, such as demographics and international demographics. And I thought, you know, this is an interesting approach to how you see cycles and reaching back into history. And you're saying that this recession, i.e. depression that we're in, is just beginning.
Yeah, you know, the first insight, and it's so simple that economists have missed it, about every 40 years, and this is a clear generational cycle in spending and then saving, we've seen major long-term peaks in our stock market, not normal recessions or downturns. The stock market peaked in 1929, didn't really bottom in that whole down market till 42, and then boomed from 42 to 68, a nice 40-year cycle. It peaked again in 68, didn't bottom till 82, and it's been booming until 2007. And now we turn down another 12 to 14-year cycle. This is a natural 40-year cycle. And note, in this case, 39 years, 1929, 1968, 2007, we get these major long-term peaks. And most economists and government officials and politicians saying, okay, yeah, we have a banking crisis. Yeah, it's kind of bad, but we'll fix it and we'll be back on the road to prosperity in the next year or two. Japan already went through this. Japan had their peak with their baby boom in 1989-90. We predicted back then they would have a 12 to 14-year downturn, and they did because a generation stopped spending and started saving. And they don't buy houses and cars after that.
Mm-hmm. Now, as president of the H.S. Dent Foundation, your mission is helping people to understand change. What exactly is it that your company has been able to do where you kind of seem like you're standing alone as far as what you're talking about and sharing with the public out there?
Yeah, we're not trying to be contrary per se. It's just that our research is so different. We do fundamentally found our research around demographics first. I mean, in other words, people do predictable things as they age, just like life insurance actuaries learned a long time ago. And we have these generations of people like the baby boom generation or the Bob Hope generation before them or the echo boom generation afterwards that buy houses and spend money and borrow money and save and do all these things in waves. And so, you know, we tell people you can see these long-term cycles. And we also look at technology cycles. We look at other cycles that repeat. I mean, most people aren't aware, even though it should be more obvious, that commodity and oil prices peak about every 29 to 30 years. It's another clock, 1920, 1950, 1980. I mean, and here we are with another major peak, and people are surprised that it's happening. And what's interesting here is we have two of our most important cycles, this 40-year generation cycle and this 30-year commodity cycle, peaking right around the same time and both pointing down for the next decade. So that's double trouble.
Mm-hmm. Now, you offer opportunities throughout your book of how people can see the opportunities rather than following the masses saying, well, we're just going to have to scrimp our belts together and start eating, you know, peas and carrots, for instance, and it doesn't have to be that way. How come people tend to follow that kind of information rather than trying to find alternatives and take advantage of situations such as the possibilities of the situations that we're in?
Well, you know, the funny thing about human nature, and anybody who studied it objectively kind of sees it, what people mostly do is they copy and imitate people like them or people just above them that they respect. And so we have this kind of S-curve as another one of our tools about how new technologies or trends get adopted. It takes a long time to get, you know, the first 1% to do it and experiment, and then the the trendsetters come in behind that, and it takes a good while to get 10%. But once 10% of people do something and it's proven, it goes to 90% in no time. Mm-hmm. And that's what happens with all these patterns, or learning about our theories, or stock booms and busts. People pile into something in the greatest numbers right at the end of the trend, and then they all go off the cliff together. And for that reason, it's not surprising that 1% of people in this country, and it's an extreme right now, but they control 45, 47% of the financial assets and wealth, and 10% of people control over 80% and pay all the taxes. It's because these people who understand things and adopt early and do it ahead of the masses get more of the benefits, and that's what entrepreneurs do. And it's unfortunate, but that's kind of the way it is. And so most people, towards the end of a boom here, and same thing in the late 80s in Japan. In Japan, everything had gone so long, real estate had gone up for everybody's lifetime and for decades, and people just think, well, real estate can't go down. And that's the biggest problem. It's not just, they know stocks can go down, they've seen that, but people in this last decade, the biggest mistake by banks, businesses, and individuals was real estate doubled and tripled in some places in 5 years, and everybody just thought, well, it's as solid as gold, and lend against it, buy, and no money down. And the banking crisis is revolving around this real estate bubble that now is going to continue to crash when baby boomers aren't buying houses anymore, and they're dragging the economy down. So we warned people back in 2003, 2004, don't buy into this housing bubble. It's going to peak, and housing prices are going to go down 50% or more when it peaks. And people are like, no, real estate can't go down that much. Well, hey, we showed people it's already gone down 63% in Japan, and went down 30% in the Great Depression, and we didn't even have a housing bubble back then. So these things, what we show people, if you're alert and understand what actually drives the economy, and it's not the government and all their monetary and fiscal policies that economists study, it is these predictable technology, demographic, generational trends, and things like these commodity cycles. And if you can see these coming, the biggest part is you don't get your wealth destroyed when the bubble bursts, and secondly, you can do something different than most people are doing when things are going down. I mean, what this is going to end up being in the next few years is the greatest sale on financial assets of our lifetime. We're not going to see this again. I mean, housing is going to be down 50 to 60% in general, and it could be down 60 to 90% in some of the most overvalued areas. Stocks are going to be down 60, 70, 80%. I mean, for the people who didn't lose all the money on the way down and kept good cash flow and credit, and just simply, even broadly, saw these natural peaks and seasonal changes coming, this is a huge opportunity.
Mm-hmm. Well, that's what I was thinking myself when you take a look at the fact that we do have real estate that's beginning to bottom out, and I don't think that it's hit the bottom yet. In fact, you talk about that in your book, that we've actually got a couple more years before it actually hits the bottom. To me, what I immediately see is this would be the greatest opportunity to invest in real estate, not by over-leveraging, of course, but do you feel that this would be a good time for people to get into buying real estate for the long term as far as that looks?
Yeah, not yet, but I have seen instances, friends and people I know in the business, like in southern Florida, where I am more, where they're getting such deal. They're buying condos for 70, 80% in foreclosure. Well, if you're getting something that cheap and you can rent it out at some reasonable price, even if it falls, then yeah, that could be an opportunity now. But as a general rule, real estate has started to fall very significantly, already way more than anybody thought it could fall. It's probably going to flatten out, maybe come up a little bit this year. Then I think we're going to see another slide into 2010, 11, 12, and maybe a little longer. And I'd rather just wait until this really settles out and buy. We're telling people, as a general rule, probably the best time to be looking seriously at real estate long-term again is in probably late 2012, early 2013. Now, there could be exceptions to that in different parts of the country or certain deals, but our thing to people over and over again is don't think about this like any other downturn you've seen in the last few decades. This is going to last longer. It's going to go deeper. We have a generational tide shifting from spending to saving, which is going to make it impossible for the government to stimulate their way out of this past the point. And you've got this banking crisis that is way more than subprime. Just a few percentage of people that shouldn't have bought houses. A lot of people bought houses, even people that could afford them, at way overvalued prices, and now those houses are going to be worth less than their mortgage in the coming years ahead, and that's going to continue to wreak havoc in the banking system. So this is not something that we can work out in a year or two. these financial crises like this, and we've studied them back in Asia in the 90s and early 2000s, and in the Great Depression in the 1840s and 1930s, and all these things. It usually takes 3 to 7 years, typically about 5 years, to work out a crisis like this. So as a general rule for most investors, unless you're just really cherry picking in between, probably better to look to make long-term investments. 2012, you just keep selling your stuff when it bounces here, keeping more in cash and safe stuff, and you let everything fall. That's the discipline of this, what we call winter season or deflation cycle. Something, again, nobody's seen in their entire lifetime, unless you're like 90 years old or something. That everything goes down, bubbles burst, and holding cash, and even being in safe currencies and stuff like that, is a way to preserve your capital while everything's falling, which means your money is worth a lot more and you get to buy stuff at the bottom cheap, because people say, well, I'll just buy stuff at the bottom anyway, but hey, who's going to give you money? Your assets are going to go down if you're sitting in this. Banks aren't going to lend you money. They're going to get tighter and tighter. It's the people who preserve their capital and have it liquid cash that can step in and buy all this stuff at 10, 20, 30 cents off. And it's an unbelievable opportunity. It's exactly how the Kennedys made their fortune in the Great Depression.
It's really interesting, too, because when you talk about the stimulus plan, it seems that everybody now has a handout. There seems to be stimulus money coming from everywhere. And as a general rule, the more money you print, you tend to see more inflation, because there's that illusion that people actually have more money when, in fact, they have about the same. It just seems that way. Now, that being said, the U.S. dollar, you kind of wonder how much value does it have, and will it continue to be the measuring stone from which all other currencies are measured, or do you see there'll be a change in that? Because you mentioned about putting in your dollars into safer currencies. Let's talk about that.
Yeah, well, let's talk about two things there that you brought up, and I'm going to hit the first one, which is a little easier and clearer for us. This is also something we haven't seen before, and that's called deflation. And it's true. Everybody I know that's bearish, that thinks more like us, that's seen this thing coming, they almost always say, oh, this is going to end up in inflation, you got to buy gold and protect yourself from inflation, and we say no. We might get a little inflation in between from all this stimulus, but what's happening here is that wealth, credit, loans, money is being destroyed faster than the government's creating it. I mean, just for example, we just showed in our newsletter a graph recently where household net worth, since, in the last year and a half, has dropped $13 trillion. Now, we're talking about a trillion here and a trillion there and a few more trillion and more trillions to come, but all the government stimulus thus far and even planned doesn't even bring us back up to what people just lost. I mean, real paper wealth and real stocks and real houses, things people could have borrowed against, people could have used for their retirement. We're destroying it faster than it's being created. So people think, oh, inflation, yeah, they're printing money. Well, that was the 70s. That was another season. Our models show that, that we have these different seasons. The inflation season's like summer, where you get overheated and you get inflation. Then you get a fall, wonderful, glorified boom, bubble boom, with all the trees turning red and yellow and a glory. And then you get winter. Winter's about prices coming down, shaking out the bubbles. After a long period of innovation and a lot of capital and a lot of capital creation, you bring down the economy to the business models and the companies that really did the right things by accident or on purpose, and you destroy a lot of banking, destroy a lot of money, and you destroy a lot of companies and a lot of jobs. And so that's what the 30s was. It's a shakeout. And it is deflationary. Even though the government tries to inflate to offset the downturn, when you have a generation saving, not spending, it's hard to stimulate them, particularly to buy and borrow money to buy houses and cars. They don't need it. But most importantly, the banking system overinvests in all these businesses and all this real estate that bubbles up, and then they have to write off these loans, and it destroys credit. The banking system, you've heard about hedge funds being leveraged 30 to 1 in their investments. The banking system naturally is leveraged 10 to 1. They take in $1 from you as a deposit and eventually lend out $10. So it doesn't take 10% or more of loans fail, and the banking system's on its back, and that's the problem we have right now. So deflation is the trend. And in inflation, yeah, you want to hold gold or even real estate, but in deflation, high-quality bonds and cash and safe currencies are the only thing that do you well. Now, the other thing you're talking about, and this is a little more of a question mark to us, but yes, the U.S. dollar, for a number of reasons, it's been rising lately because our trade deficit's been slowing, because of our slowing economy. And every time all these people are dumping all these foreign assets, commodities and foreign stocks where the bubbles were, all our hedge funds and investment managers, that creates a demand for dollars. But we think as we recover, the dollar is going to start to fall because China's already questioning, gosh, what are you doing? You got so much stimulus and so much debt. Europeans are saying, yeah, we think you're going too far. And we agree. We're saying, look, our government's going to rack up trillions and trillions of dollars of debt, and they're not going to really turn around the economy. And again, Japan already did this. 100% of their GDP is stimulus in the 90s, and they still couldn't pull out of a long deflationary spiral. So, yeah, our guess is the dollar is going to go down substantially the next year. And in fact, the dollar may have to continue to go down, not because of inflation, but because the world starts saying to the U.S., we don't know that you're going to be able to pay back all these debts and all these things you're guaranteeing. We're starting to question the credit of the U.S. government. And that also means, as China's warning, gosh, how can we have the U.S. dollar as the reserve currency for global trade when you got what appears to be a darn near bankrupt nation behind it? Mm-hmm. So I don't know exactly how that plays out, but we tell people in general, I'm not as keen on gold as I am being into currencies counter to the United States, safer banking systems like Canada, Australia, New Zealand, and Singapore, and Norway and things like that. And you can sprinkle some money overseas, but still, if you're holding cash here, the value of things are still going to go down. Real estate, commodities, and stocks are still going to crash, and you can buy them cheaper. But gosh, if you're holding some of your cash overseas, and those currencies go up and the U.S. goes down, then you've amplified the value of your capital and your money and your buying power. So that's, for more sophisticated people, we say be in cash around the world, outside of the dollar largely. And for less sophisticated people, look, just go to cash, be in very safe T-bill money markets, and play it that way. But there are some arguments that say, and we think even gold at some point, but we've told people to get out of gold recently because it got overbought and overvalued. But if we really do move into deflation in the next year or two, I'm not, gold is more of an inflation hedge. It's also a banking crisis hedge, some other things, but gold may not go as high as some people think. We've got question marks about gold. It depends. If it breaks the new highs, then we would tend to tell people to buy it, or if it broke really low here in the next year. But I'd much rather be moving out of this stock bubble when it peaks maybe this summer or fall, this rebound, and just get into T-bills, or like you say, sprinkle it around to some other safer banking currencies.
It's quite interesting, too, to realize that as you hear people beginning to share all their stories about money they lost, some of the consistent areas that you see people losing money in are usually company pension funds, 401ks, IRAs, and the like, mutual funds, and these are always these traditional products that are always pumped out there where people think that it's safe, there's little to no risk. And right now they seem to be the riskiest thing you could have your money in. Why don't people educate themselves to go in different directions so they can follow these cycles and be better prepared, as you're talking about?
Well, part of the problem, and we talk about this in the book too, back towards the end in chapters 7 and 8, about how risk changes over time in these different seasons. And the problem is our financial experts, most financial advisors, and certainly almost all economists, don't educate people to this. They just say, asset allocation. If you spread your investments around, international, domestic, bonds and stocks, real estate, commodities, you'll be okay. And we've been warning people for years, look, when you come to this winter season, this deflation, this bubble bust, everything goes down. So diversification and asset allocation doesn't work. And that's the thing is, most people are in these 401ks. They say, I was some in REITs, and I was some in bonds, and I was some in stocks, and some in small cap and large cap and international, and everything's going down. Mm-hmm. So they are getting hit, and then the advisors just tell them, well, that's all right. It's a correction. Hang on there. It'll come back. And remember, we said, you get these 39, 40-year tops in the market, you don't come back to those levels for 2.5 decades. Mm-hmm. And so people are going to get a rude awakening here, and the reason they're not going to do something smarter is all the experts on CNBC and all the experts and their advisors and economists are just saying, this is a problem, but hold in there, and asset allocation will work. It's not going to work, particularly in this circumstance, and it's very unfortunate. And, there's only a minority of people like us that warns people otherwise. The truth is most people listen to the credible experts at Merrill Lynch or Morgan Stanley. That's what they do. And all these economists and stuff. And these guys, frankly, from our point of view, don't have a clue what's happening. And they think this is just a banking. They think it's a banking crisis that can get fixed. They don't understand the largest generation in history is going to be spending less money, no matter how much money you give them in stimulus. They're going to save it. They don't need to buy houses and cars. Their kids have left the nest. It's over. And then the younger people are still too young to come in and make up for those. I mean, these generational cycles are the most predictable things, and economists totally ignore them because they don't want to look at something new and different than they were taught at Yale. And that's the problem. Our experts don't have a clue, so people don't have a clue.
That, or they probably do and they just don't feel like talking about it. But I agree with you. They probably don't have a clue at all because...
Believe me, I talk to you, they don't have a clue. And you explain it to them and they go like, oh, poppycock.
Exactly.
They think the government can control the economy like a thermostat. If it's down, they'll just stimulate, it'll come up. If it's too hot, they just raise interest rates. And that works like a cup of coffee or something to a degree short term. The government had nothing to do with this boom. Bill Clinton had nothing to do with it, even Ronald Reagan. They do certain things, good or bad, and mostly fine. It's just baby boomers grew up and spent more money. I mean, and Bill Clinton sat in office for 2 terms where he couldn't do any wrong. Real interest rates went down because of their productivity, and spending went up because of their aging, and the economy was hunky-dory.
I always find it interesting, too, when you see situations like this in their cycles, that people always turn to the government and say, well, this guy's in office, this is the reason the economy's bad. George W. Bush is the reason in his administration of why the United States is in financial turmoil. But as you're saying, it really isn't these guys at all. Now, what would you say?
I mean, it is only in foreign policy. I mean, we got into a war that you could be for or against, but it did cost us a lot of money. It hasn't produced much. That has hurt us. But you're right. The economy would be slowing down somewhere along here, regardless who's president. In the 90s, it would have boomed if you'd have had a buffoon in there.
Mm-hmm. Now, what would be the best role for the government to be playing instead of trying to come in like Superman and save the world?
Well, yeah, they really understood that this is a natural deflation, getting back into balance crisis after a glorious, very innovative boom. I mean, innovations in technology that will pay off for decades. It's a good thing. What you would do is say, look, we don't want to stop this from happening. We just want to let it be more civilized. We want to be the lender of last resort. We want to come in with liquidity and short-term loans that allow these banks and major companies to restructure and go through Chapter 11. Yes, they are going to have to go bankrupt. They are going to have to reorganize. There's no way to save them, turn them around. These banks were already dead the day they lent against home prices that doubled or tripled in 5 years. They're already dead. Even if they'd have made no subprime loans or people in trailers and all that stuff, just on the broader housing market, they're already dead. Let's just provide short-term loans so these companies don't have to panic and sell their assets at fire sale prices. They can have a little time to reorganize and do it right. And, I mean, this thing with General Motors is a perfect example. They should have done in the beginning what they're doing now. Mm-hmm. Don't tell these people, oh, we'll give you some money and take some time and do it. They didn't cut enough. Say, bam, you got this much time to come up with this reorganization plan, just like Chapter 11. That means the labor unions are going to have to give a lot more than they're giving. Your bondholders are going to have to give a lot more than they're giving. Your shareholders are going to have to be wiped out. And if you can come up with that type of plan, we'll give you money to implement that plan. Mm-hmm. But if you're not, we're not going to give you money because you're already bankrupt. And they keep putting money in these banks, and they say, okay, now we're okay. And then every time you're going to watch this, 3 to 6 months later, come back, well, we didn't know this was going to happen. Right. We didn't know the house prices were going to drop another 10%. Same thing with Merrill Lynch. All these people, well, given what we see, we're okay. No, they have no clue what's going on. Mm-hmm. This is like the Great Depression. This is a major shakeout of banks and businesses, and it's the strongest survive, and a lot of companies are going to go under. So the government it's kind of like a junkie coming off heroin. I mean, I hate to use that example because it's so overused by conservatives and stuff, but it really is the same thing, that we're hooked on this bubble after bubble. Every time the economy slows, the government lowers interest rates, throws money in it, keeps it going, and the bubble shifts, from stocks to real estate and then to emerging markets and commodities, and it keeps shifting. But at some point, you can't sustain this bubble and all this debt and stuff, so you have to come down. You have to decide at some point, we're going to come down. And you know what? It's painful. But a good doctor can administer just enough Valium and some other drugs to make it more manageable and a little less painful. They're still going to scream and puke and ache and not be able to sleep and all this stuff and have fever, but you can make it a little easier and a little more civilized. That should be the role of the government. The problem is people want the government just to make the owie go away. fix this. And the truth is also, and this is really sinister, everybody knows that everybody's too much in debt. The hedge funds borrow too much money, investment funds, investment banks, companies, and mainly consumers. We bought all these houses at high prices and put nothing down and then borrowed against them additionally to get our kids into private school and stuff. Consumers are way too much in debt, and what needs to happen, everybody needs to slow down, pay off debt, and get back into decent shape again. Government down to consumers. And the government is actually saying, no, we don't want to go through that pain. We don't want the economy to go through pain. And consumers and voters are saying, yeah, we don't want this owie. So they're just saying, well, we're just going to keep trying to stimulate our way out of it. It's really going to look, in retrospect, like a bunch of crazy people, did the wrong thing and didn't see the obvious. I mean, how can more debt and leverage be the answer to an economy that's got too much debt and leverage? That's the simplicity that a 10-year-old should be able to get here.
It's kind of like being able to scoop water out of a stream with a colander.
Yeah. No, I mean, this really is ridiculous. But, one way or the other, deflation wins. If the government goes too far and tries to stimulate, it'll just fail, and there will be more debt to have to be written off, and that will actually prolong. I mean, if I was advising Obama, it'd be real simple. You're screwed. You walked into the worst economy since the 30s. The best thing you could do is to help this thing happen civilized and as fast as possible, because the only way you're going to get reelected is the economy is rebounding by 2012. And if you keep trying to stimulate and stave this thing off, you're not going to be rebounding by 2012, and you're not going to get reelected. Mm-hmm. My advice would be let this thing happen and almost push it. Do it civilized, but push it. Don't put it off.
Mm-hmm. It's really interesting to look at it from that perspective versus the mainstream and how everybody thinks that the government can buy their way out of this thing, and then everybody's cheering them on and they're doing what they perceive to be the best they can. But, obviously as I'm reading through this, you make a lot of key points that are totally being overlooked, and unfortunately we don't have the time to be able to cover a lot of this, so there's so much to cover. I'd like to welcome that opportunity for you to maybe come back so we can go more in depth about some of the areas that you talk about, such as demographic migration, immigration, education. I mean, there's a lot of areas in here in this book, and you were actually, from what I've been reading, you're out there in 2057 for crying out loud, so you're really looking long term about how things are going to look depending on what our action is today. Now, you said earlier that you do have a newsletter. Is this something people can subscribe to?
Yeah. If you go to hsdent.com, you can get a free sample of it. It's $299 a year. It's the best service we have to offer because, we put out major books like this every 5 years, and we have enough major new research, and there's enough major changes in the economy. But most people in between we have a lot of updated research and a lot of changes and things that we have in between. So the newsletter is the way we can keep talking to people, and we have everything, it's a monthly newsletter, but we have expanded quarterly editions like April where we really update our longer-term research and outlook, and then we have up to daily updates if necessary when the markets are really kind of crazy as they've been in the last few months. So it is something I recommend for people who have an interest in investments or own their own business and have enough of a stake to say, look, this is serious stuff, and it's the only way we can keep in communication with you other than getting on a show like this.
Mm-hmm. Well, we appreciate you taking the time to come on. Like I said, this book is really in-depth, and it was quite different from what you're generally seeing out there. In fact, we had a particular guest on the program months ago who was talking about now's the time to get into gold and silver and mining stocks, and you're saying, well, no, that's okay in an inflationary period, but we're more in a deflationary period. So you can see how you're different from the tide, and it's refreshing because it's like looking for someone who's lost out at sea. You've got to kind of go around all angles because sometimes you'll see things differently from one angle than you would another, and that's what you want to be able to pay attention to. The book is The Great Depression Ahead, How to Prosper in the Crash Following the Greatest Boom in History. And Harry S. Dent, Jr., thank you for joining us here on the program today. It's been a pleasure.
Yeah, thank you.
You bet. Go ahead and give out a website real quick where people can find out more about what you do.
Yeah, www.hsdent.com.
Thank you very much again for joining us. It's been a pleasure. I'm Daniel Davis. Thank you for tuning in. You've been listening to the Beyond 50 radio program. Be sure to visit us at our website at beyond50radio.com. That's the number 50 with a 50, and sign up for our free weekly e-newsletter. Again, thank you for tuning in today. You've been listening to the Beyond 50 radio program, and remember, live your day past halfway.